I'm Priscilla Barrera with the Investing News Network, and here with me today is Rodney Hooper of RK Equity. Rodney, thank you so much for joining me today.
Great to speak to you again, Priscilla.
So I wanted to start by asking you about the lithium market performance so far this year. We're almost entering the second half of 2023. Did the market performance you expected at the start of this year?
I think we were caught a little bit off guard based on my numbers of supply demand. Actually, what we saw last year was a greater deficit than expected as the sort of downstream stocked up. And then we started the year with a bit of weakness in China with EV sales. That's come back as of May, up about 43% year on year. So an improvement. There was a sort of buyer's strike at higher prices. So downstream is definitely pushing back on lithium prices. Anything above sort of 50 for sure seems to be unpalatable for them. So to answer your question, caught a little off guard, but we seem to be moving back to a stable region, and we've kind of, what I call the economics of lithium, are sort of playing out as expected. If you look at the linkage between spodumene and chemical prices and add a bit of a margin, it's kind of come back to that number. So more predictable. And I expect we can chat about the future, but yeah, we've come back to where I think is a fair position at the moment for the year, but a bit of a fright for the start, but we're seeing demand pick up.
And when it comes to prices, we saw prices fall from November to April. We're now seeing lithium prices rebound. What do you expect to see for the rest of 2023?
So on that front, it's interesting with the drop in prices. We chat to the entire upstream and downstream as well as traders, and I was warned there was going to be a buyer strike. They suggested the price would pull back to around 320. Of course, it went straight through that and further below. But looking for the year ahead, I think still, and I've said this before, I believe that spodumene as the feedstock is the sort of marginal producer in the market, not lepidolite. That being the case, the price of spodumene will still effectively, on a look-through basis, dictate the price of chemicals. So that at around $4,000 a ton, if you check my presentations, correlates to roughly around 300,000 renminbi as a price, VAT inclusive with a small margin in it. I do think that people are grossly underestimating energy storage demand for the year and for the future. Every presentation, every analyst forecast I see is way too low. I've spoken to various people along the chain and China, and so I'm expecting big things there. So if we see a recovery in EV demand going up towards the end of the year, I think ESS can add to that, and we could see something of a price squeeze, or slightly higher prices towards the year end. I don't know if that will, have spodumene running with it, but I do think there's potential for producers to hold back a bit of volume and cause a bit of an upward vacuum in prices, but we'll see. As I said, the downstream doesn't like higher than 50, but they aren't always in control.
And when it comes to lithium supply, you've been talking for a while now about this structural supply shortage. What factors do you think could derail that prediction, if anything?
So what could have derailed it is high inflation and a recession. So disposable income, because the one trend that does sort of play on my mind, Priscilla, is the cost of EVs needs to drop. You're still, the offering that is in the States and China is starting to. You've seen BYD introduce the Seagull at $11,000 and some of the others, but ex-China, the price of EVs is still quite high, which means it aims and is targeted at a certain buyer's market, and that's not infinite. When the early adopters can switch to EVs, they will and have, but that market is not infinite. You need to be able to produce attractive, competitive EVs in the $20,000 to $40,000 range, and that's not happened yet because of battery raw material prices. So a derailing could be effectively a blowout in demand where EVs just aren't affordable to a big enough mass. That hasn't happened this year. China's picked up a lot of the slack. It's got very aggressively priced models, and they're seeing good sales, but as you know, this thematic needs to go global, so we are going to need to see better priced offerings. So not this year, but a derailing in the future is we need to see lower priced EVs. Even after subsidies, it's got to come down.
All right. And one of the things we have continued to see this year is OEMs getting more involved in the upstream. What do you think are some of the risks and challenges of OEMs partnering and investing equity in mining companies? And how do you think all these partnerships will evolve?
So I think one of the things is it's been, thematically and optically appealing for OEMs to put money into DLE and new technology plays because they're low carbon or zero carbon or net zero. And what we've seen is cost blowouts and production timeline blowouts from them across the board, I would say. So that's not to say that those projects won't work in time, etc., but how much will they cost? When will they reach battery grade? Because this is what OEMs need. The dilemma, I guess, they face to some extent is that conventional flow sheets are the projects that can get you your lithium in early stage now, sooner. So the risk is in investing in something that's palatable to ESG-related shareholders and to PowerPoint presentations, but there's a reality if you want to make EVs. And there is more of an acceptance from the downstream and the OEMs to invest in projects that have zero carbon, to put the money in. They're more reluctant where there's more mining related, what people consider. I don't agree. We've had Ken Brinsden before on our podcast agree. There are ways to bring down CO2 emissions on conventional flow sheets, and I think that should be a focus for people because it will, it can assure you of your material and prove to be, lower on the carbon scale. So OEMs have stepped up. They've realized the need to do it. We know, despite various brokerages, saying that there's going to be oversupply. We know incumbents and other market sector companies looking to get into lithium and looking at companies that we consult and work with at very early stage, which contradicts an oversupply argument. So I'm sure you're going to get to it. My philosophy is still again that OEMs cannot just secure volume. If they give funding, if they give prepayments, if they manage to somehow get a discount on the material, that's great. But it needs to be enough that they can make it work. And to my mind, if you want to be competitive in the long term, you need to secure on the basis of supply and price.
So when it comes to new supply, I think one of the regions that has been receiving some attention is Africa. So what do you think of potential supply coming from that continent, and what should investors maybe pay attention to when looking at companies developing projects there?
So Africa is my homeland, and it's had an interesting, if not troubled, history in the mining front. That said, Lithium's been a great project. I think that's going to play out for Ganfeng well. I think that could be a very large asset in time. It is quite far from coast. It is in Mali, but there are, that share price has performed well. Howard and I, from a technical perspective, in terms of grade and quality and potential, that's been too good to ignore. You've got Atlantic Lithium. Again, it's in a good mining jurisdiction as far as Africa is concerned. Paved roads, deep water port, so on. Zimbabwe, I think one has to be careful. Zimbabwe has imposed, they buy electricity from South Africa. South Africa now doesn't have electricity, so Zimbabwe is without power for sometimes as much as 18, 20 hours a day. which means, difficult circumstances. They want to beneficiate in country. So you've got to look at it country by country. I think China has rightfully decided that's where they are going to get their material, because tier one jurisdictions are trying to do vertically integrated deals or deal with Europe or elsewhere. So Africa has the material. Can it, in terms of how long a lifespan that will be, in terms of the quality, in terms of the reliability and political regime, you need to do your homework. But, there has been a long history there, and I think that that will fill a percentage of the market, but I don't think it can rise up to meet, what is, a quickly expanding market.
All right. And what about Canada, I guess, is my next question. We've heard a lot about Quebec. We also heard a lot about how the government continues to push for more partnerships when it comes to raw materials. How optimistic are you about supply from Canada?
So I wouldn't neglect Ontario along with Quebec, and there are other provinces. Lyft is doing, a project elsewhere. So as far as early exploration and opportunity in finding big resources, Canada is fantastic because it's underexplored for lithium. And I do think, I don't argue with Elon Musk when he says lithium is abundant. It is abundant. It's a question of economic resources. I do think, like the Patriots, like the Winsomes that have come up now, they're looking to come out with good resources. There will be more. I think you have to be realistic. Australia is still top dog in terms of timelines to production. Pilbara showed it, from first drill to production in 4 years. And if you look at the rate that Global Lithium is accelerating its projects, it shows what Australia can do when they flex their muscle. They can move really quickly. And that's an example of a project that, Canada can't meet those sort of timelines. But I think there are fantastic deposits. I think, that the North America is looking to have an insular supply chain. The IRA will, I think, benefit Canada. But you just have to, be realistic about the permitting and time to production. But I think in terms of quality of resource and size of resources, again, another one I mentioned, Frontier, that's on its way to a big resource as well. But you've got to look at infrastructure, you've got to look at permitting, and then, what are you going to do with the material? Are you going to set up a hub in Thunder Bay? Are you not? Are you going to ship it to the US? But we like Canada. Again, everything has a price. You asked me this, I think, when I saw you last year. I think you got to look where things are fairly valued and where there's opportunity for upside. If things get ahead of themselves, then it's tough. I think that's what some of the new technologies, people started to discount them on the basis of NPV when the proof of concept wasn't quite there yet. So I like Canada. We have backed it. We think that it is going to play a role in the future, but one has to be realistic on timelines.
All right. And I wanted to circle back on DLE. And just maybe, what are your thoughts on companies betting on direct lithium extraction, and what do you take into account before investing in a company claiming to have any kind of technological breakthrough?
So, DLE was the flavor of the month or the year last year for a period of it, and I said, look, we'll see. Now they are all sort of near their 52-week lows. So the market has soured on that a bit. Again, I think DLE is an opportunity, but it's an option value. You can't value it on the basis of it'll produce X and discount it as you would a hard rock or brown deposit. I do think there is potential for more applications like Livent uses DLE. I think there's some good brown projects. You've got, Galan looking to make an intermediate product. I think that's quite a smart play. But I guess the way I look at DLE opportunities has always been to value it as optionality rather than as a project, any sort of cash flow discounting and so on. And I think the market has now decided that is probably more the way to look at it. DLE is needed. But one has to remember that it's like a fingerprint. Every fingerprint is different. In the same way, every brine is different and how you need to treat it. I will say, as a broad consensus, the capex costing for DLE projects has blown out. Their numbers are just, I'm seeing around 60,000 for a few of them, and I don't think that's the last of it. So, it's a big bet on a new technology, but it is needed. It would fit very well in the ESG narrative. So, we hope that it does work. But again, we felt that timelines need to be more realistic in terms of building up pilot plants or projects on a stage-by-stage basis and then seeing that they pan out. So we're not anti-DLE. We think that it is an opportunity, but you need to pay what I consider an option premium for it, and you need to be very realistic on the timeline and the costs. But we're seeing high prices now. We think that those can be sustained for a while, so we are more inclined to be keener on near-term production, conventional flow sheet, or brine, hard rock. Obviously, we've done because there's conversion capacity out there to take it, but we're also pro brine in the sense that if you're up and running and almost there, that's great because they're low-cost producers. We need to see DLE proof of concept here at scale in the Western world. I know it's done to an extent in Qinghai, in China, but I don't have look-through as to the quality of that material and the true costs and so on. So I'm still waiting to see a flagship project, in a tier 1 jurisdiction outside of China.
All right, Rodney, my last question for you today. Would you be able to share any key lessons you've learned this past year when it comes to investing in lithium/battery metals?
Sure. Interesting question. I think investors still need to be very cognizant of global macro factors. We think we get a little bit of, a myopic view of our little sector and so we've seen different headwinds, inflation, Ukraine war, a possible recession and so on actually affect the lithium market when the fundamentals within the lithium market have looked to be sound. So lithium is not a commodity. It is a specialty chemical. I mean, spodumene, I guess you could draw, analogies to other commodities and maybe think of that as more, but it means that there is cyclicality in the price of the chemicals and spodumene and in the share prices. So I think investors would do well to take money off the table when they've had substantial returns and look to re-enter when shares have been beaten down. I think the buy and hold, you need to be brave. It's not to say you shouldn't. It's just there are buy and selling opportunities given the world that we live in.
All right, Rodney, thank you so much for joining me today.
Thanks very much.
Thank you for watching. If you like this video, make sure you subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below. We'll see you next time.